Well, hello everyone, and welcome to today's seminar. This is Summitry's fourth quarter investor update. Thank you for taking the time to be with us today. My name is Cynthia Duncan, and I'm a senior financial advisor at Summitry, and I will be your moderator for today. Before we get started, I'd like to go over a couple of items. First of all, if you would like to ask a question, please feel free to select the Q&A icon at the bottom of the screen, and I'll be gathering questions as we go along today. We've allowed lots of times for questions at the end of today's presentation, so I encourage you to ask anything that might be on your mind. Second, if you miss anything today, don't worry. We will be sending out a link to a recording of this webinar after today's session. And included in that will be a short evaluation form, and do know that your feedback is always appreciated. I'd like to begin today by introducing our speakers. First, we have Colin Higgins, our Chief Executive Officer. Next, we have Kurt Hofer, CFA and Chief Strategy Officer. Michael Kahn, CFA, Director of Research and Portfolio Manager. Matt Gordon, CFA, Senior Equity Analyst and Portfolio Manager, Jack Zhao, CFA, Equity Analyst, and Jason Yu, Research Analyst. Let's go over some of the topics that we'll be talking about today. First, we'll have Kurt share a general overview of the market. Then we'll transition and talk about portfolio changes that have been made this quarter. And then we'll conclude with our long-term focus and lessons we've learned from the past year. And boy, what a year it's been. So with that, I would like to go ahead and transition over to Kurt, who will start us out with the market update.
Thank you so much, and hello everybody. We're undoubtedly experiencing a recovery in this economy, even though there are obviously very visible pockets of weakness. We see it every day. But here are a few indicators that we watch. The next slide. Here's what we show here what's called the 2-10 spread. It measures the difference between short-term and long-term interest rates, and specifically 2-year Treasury notes versus 10-year Treasury notes. The spread in yields between these two securities is narrow, as it was in the latter part of 2019 and into the most acute part of the COVID crisis. It typically means that growth expectations are very low. When the spread is expanding, as it is now, it shows that investors are expecting an acceleration of growth. Incidentally, while a widening 2-10 spread is a good sign for financial institutions, and particularly banks, who borrow at short-term rates and lend at longer-term rates. Next slide, please. Among the indicators that we watch for signs of economic health, the ISM Purchasing Manager Index indicates whether orders for goods and services by purchasing managers are increasing or decreasing. Any reading above 50 indicates an increase in orders, which is a great leading indicator of an expanding economy. And this is certainly what we see today. Next slide. Wall Street analysts signaled their expectations of economic growth in the earnings estimates that they publish. As you can see, analysts are seeing a strong recovery of earnings in 2021. What's most interesting to me in this chart is the speed of the recovery, at least in the expectations of analysts relative to prior recessions. Because this recession wasn't caused by imbalances in the economy, as in 2001 and 2008, whose recessions are indicated by the gray bars. But rather, this recession was caused by a factor unrelated to the economy. It's felt that the return to normal will be quicker, the V-shaped recovery. In fact, the big boost built into expectations of earnings might relate to a lot of pent-up demand. Next slide. Of course, our government has gone to extraordinary lengths to save the markets and the economy from collapse. And they've done this through massive liquidity infusions and deficit spending. It worked, but the legacy is a lot more debt on the balance sheet of our federal government. On this slide, you can see the gray line that households have been fairly responsible over the past 10 to 15 years in managing their debt loads. Household debt has actually trended down relative to GDP. On the other hand, the federal government has leveraged its balance sheet to provide stimulus to the economy ever since the 2008 global financial crisis. The concern to investors is the potential that the government's actions will lead to inflation. Next slide, please. And investors are concerned because historically elevated inflation has hurt the prices of all financial assets, including stocks. On this slide, you can see how higher levels of inflation have been accompanied by lower valuation multiples. To explain this slide, lower inflation levels are on the left, higher inflation on the right. PE ratios, a measure of valuation, have declined with higher levels of inflation. The relationship works something like this. Higher inflation leads to higher interest rates. High interest rates make bonds competitive with stocks and they pressure stock values. Next slide. Speculators in commodities like gold that are seen as proxies for fiat currencies have seen some of those assets bid up, suggesting that inflation concerns exist in certain corners of the market. Next slide. But these feelings aren't universal. Surveys of inflation expectations, like the University of Michigan Inflation Expectations Survey on the left, show little concern. After higher inflation expectations formed at the height of the crisis, when the Fed began unprecedented quantitative easing and the federal government announced its rescue package, but these concerns have waned in subsequent months. A longer-term indicator is on the right, which shows the Treasury bond market's view of inflation expectations 5 years from now. The Treasury market, which is certainly broader and deeper than the market for gold, doesn't seem to be concerned about inflation. Next slide. And the Federal Reserve itself provides its views of future inflation. On this page, we've presented the views of the Fed officials as to their expectations of Fed funds target rate in 2022. The low expected Fed funds rate in 2022 suggests that Fed officials, who certainly have as much economic and financial data at their fingertips as anyone on which to base a prediction, see little likelihood of inflation in the coming years. So next slide. Some takeaways. They're as follows. First, it's been a tough, uncertain year, but the economy's been incredibly resilient. The economic data we see point to economic strengthening. Second, market signals are agreeing with this assessment of the economy. The rise in equity markets makes perfect sense to us. Third, government has added fuel to these market recoveries government's taken extraordinary steps to prime the economic pump, and it's working. But the costs are that we have to be vigilant. Because fourth, the classical economic thinking suggests that we watch for signs of inflation. We watch a broad range of indicators and make sure when we're allocating your investment dollars that we're hedged to the best of our ability against this risk. We do it, as you know, the best way we know how, which is to buy individual securities that we can evaluate for their specific strengths and specific risks, rather than invest in large swaths of various markets. We like the control that our approach affords us. And with that, we'd like to move this conversation to our specific actions over the past months, and I'll let Michael take it from here.
Thank you, Kurt, and hello, everyone. Since our last client call, we added to our position in Lowe's. As you know, we watch the names we own very closely and review and analyze the results each quarter. In many cases, we do additional research if we have questions about the performance of the business. After reviewing Lowe's most recent results and doing some additional work on the company, we saw evidence that Lowe's has been gaining market share and that the company is making progress on closing the profitability gap with Home Depot. So following this work, we reevaluated our fair value estimate and concluded that Lowe's was attractive enough to add to the position. The second decision we made was to sell out of Cognizant. We first bought Cognizant in 2016, and we have done a tremendous amount of work during our ownership period. Our thesis was that Cognizant benefited from strong competitive advantages that stemmed from its focus on IT outsourcing for health insurers and banks. And this thesis was playing out for a while. Now, one thing we pay close attention to is change in leadership. And Cognizant appointed a new CEO last April. This change prompted us to conduct additional due diligence to better understand the new direction for the company. And we didn't like what we learned. Our research showed that Cognizant is likely to expand into more competitive areas in which it is less differentiated than peers and doesn't have the same competitive advantages as in the legacy businesses. We think this direction presents some risks for the company, and since the stock was trading around our fair value estimate, we decided to take a more cautious stance on this company and exit the position. And with that, I'll turn it over to Matt to discuss some of our lessons from 2020.
All right, thanks, Michael. Next slide, please. So long-term clients on this call are probably very familiar with our investment framework. So I'm just going to provide a quick refresher here. Basically, we understand that stocks represent partial ownership in businesses that have value due to the cash flows they generate over time. So we focus on investing in quality businesses with competitive advantages because this protects those cash flows from competition and macroeconomic forces. And then we try to buy these businesses at a discount to their value. Focusing on quality businesses and buying at a discount provide a margin of safety because we know bad things can and will happen to our companies over our holding period. And this year was certainly an example of that. So with this framework in mind, here's how we have responded to the pandemic. Next slide, please. We shared this slide with you on our quarterly investor call way back in March. I think it bears repeating because it captured so well what was happening in the moment. Back in March, we emphasized that while some may have dismissed COVID-19 while it was contained in China, no serious person involved in the markets can today, because while one might dispute mortality rates and other statistics specific to the virus itself, one can't dismiss that it has disrupted our daily lives and has shaken confidence, which is fundamental to our economic and market system. Recession may have seemed a remote possibility a month ago, but it is a very real possibility in the near term. The question is, if there is in fact a recession, how deep, how long, and what does the recovery look like? Our belief is that the effects will be temporary. So why did we feel comfortable making that claim? Next slide, please. Because as we have discussed often, volatility is nothing new to the markets. In March, we highlighted that just during the past decade, we counted 13 significant market moving episodes. And while these other events have faded from memory, we know well that when we were in the middle of them, they certainly seemed novel and material with no clear solution in sight, yet the markets survived them. Next slide, please. Here you can see a chart of the S&P 500 over the past decade. Despite each of these seemingly dire events, the market still provided a total return of more than 13% per year over this period. But more so than historical market resilience, it was our investment philosophy grounded in the fundamentals of business analysis that allowed us to not only stay the course, but also take advantage of the sell-off. So let me turn it over to Colin to explain why.
Thanks, Matt. So obviously we have the benefit of perspective that markets have remained resilient in the face of uncertainty and risks in the past. More importantly, we have confidence in our investment philosophy, which, as Matt said, is grounded in the fundamentals of business analysis. This allowed us not only to stay the course, but take advantage of the sell-off earlier this year. We've discussed this in prior calls, and this slide represents how we think about the value of a stock. The intrinsic value of a business is the sum of the present value of its future cash earnings. In this example, the gray bars show earnings growth of 8% annually, and the orange portion of these bars is the present value of those future earnings. Note that for this business, since we assume it has strong competitive advantages, those growing cash flows will extend far into the future. When you add up the present value of all those future earnings, you arrive at the intrinsic value of this business. In the market, the stock price will either trade above or below this value. So digging into this example, on the right, you can see that 1 year of cash earnings equates to about 5% of the value of the business. If we rewind to the beginning of the year and the onset of coronavirus, the market declined 30% in a span of 19 days, which was the fastest such decline in history. During the sell-off, many quality businesses declined by even more than this. Based on our analysis, it was clear that the market's reaction about the impact of the virus on the value of most businesses was an overreaction, since the value of a business is determined by the sum of all of its future cash flows, not just the near-term earnings of this year or next. This disconnect provided us with the opportunity to add high-quality businesses at very attractive prices. Next slide, please. And that is what we did. We were very active during the sell-off. We added 6 new names to the portfolio, including Charles Schwab, Agilent, CarMax, Ross Stores, Varian, and Zebra. These purchases have benefited our overall performance as the market has realized the disconnect between price and value. We're also able to add and increase our position in 8 of our existing holdings, particularly in the travel and finance sectors, which sold off on concern over lockdowns and the near-term impact on the economy. Next slide, please. So while this proved to be a somewhat difficult year to start, the coronavirus-induced sell-off allowed us to upgrade the quality of the portfolio by sticking to our discipline of identifying quality businesses at attractive valuations and using the market volatility to take advantage of this. Next slide, please. So we want to share a few concluding thoughts. One, we believe there may likely be more volatility ahead because of the uncertainty and complexity surrounding the arrival of a vaccine and what impact that will have on the economy. But as we discussed, the near-term impact on our businesses is not as meaningful as a long-term outlook, which we believe is strong across the board. 2, we have significant exposure, about 1/3 of the portfolio, to some of the hardest hit areas of the economy. So when business does return to normal, we are well positioned for this recovery. And longer term, the portfolio is well diversified and positioned to do well because it consists of these high quality growing businesses that are attractively valued. Most importantly, I think we can all say this, is that we're looking forward to a return to normal, which hopefully isn't too far away. So let's open it up to your questions.
Great, thank you, Colin. So as a reminder, if you'd like to ask a question today, please click on the Q&A icon at the bottom of your screen, and you'll have the opportunity to type in a question to ask our panel today. So I want to start by asking a question about vaccines. Certainly that's something that is on everyone's mind today. And I'm wondering how that might impact, or news on a vaccine might impact our portfolios, either to the positive or the negative. So Michael, do you want to address that question for us?
Yeah, sure. I'll be happy to take that one. So I think at this point, it is safe to assume that a vaccine will be available soon. Based on everything we know so far, it's reasonable to assume that widespread availability will be around the June-July timeframe. The worst case scenario is that we will have some sort of a supply chain hiccup, which might result in a delay of a few months. On the flip side, it's possible that the parties involved in manufacturing and distribution will surprise us and will execute this massive project fast. So we might get a widespread distribution early next year. The bottom line is there is a very high chance that the health crisis will be fully behind us by the third quarter of next year. So once the health crisis is fully resolved, we expect the areas that were most impacted by this to return to their normal level of demand and activity. So We already saw the beginning of that this year in retail and even to some extent in travel, but we're still far below last year's level. So there is plenty of room for improvement. And when I look at the portfolio, over 30% of our holdings will benefit from this type of improvement. So a resolution of the health crisis will benefit the banks. Disney and Booking will benefit from recovery in travel as more and more people feel comfortable going on vacations again and flying to destinations. Sports events will resume, so Fox and Disney will benefit from having more events taking place with actual sports fans in the field or the stadium. And our retailers, Ulta and Ross, will benefit from shoppers returning back to the stores. So a resolution of the health crisis will be very positive to many companies in the portfolio.
Great, thank you, Michael. So another timely question that we got, I think Airbnb started trading about a half hour ago. And the question is, generally, how do we think about IPOs as potential candidates for our portfolios? And specifically, would Airbnb be considered in terms of an addition to our portfolio? So Jack, would you like to go ahead and address that question?
Sure. Definitely a timely question. It looks like it priced in the past, hour or so, but let me kind of address the first part. Our process certainly doesn't preclude, looking at IPOs, but generally speaking, IPOs are a little bit more speculative given the lack of track record and data that is available. For companies like Airbnb, however, it is a little bit different, because travel, and more specifically, online travel agencies, are within our circle of confidence, as we do own Booking and have owned Expedia in the past. As such, we've spent a considerable amount of time analyzing Airbnb's S1, reviewing kind of expert discussions on the topic, and generally following every piece of publicly available data leading up to the IPO. So with Airbnb, the million-dollar question is, like many Silicon Valley tech IPOs in recent memory, is if the company can reach profitability and what that profitability would look like in the years after becoming public, because every dollar before becoming public has been mostly spent on driving growth, scale, and market share. Airbnb, like I said, has been mostly unprofitable to date. But after kind of an initial analysis on this topic, there is reason to believe in a world that they can reach a normalized profit profile that is quite attractive. With that said, it's way too early to make a call, at least as it relates to our process, given the lack of proof points and generally trying to analyze how travel is behaving during a pandemic. There's a lot of noise involved. But going forward, it's definitely a company that we will be watching and following closely, not only as a potential investment, but also naturally as a competitive threat to our holding in Booking.com.
Great, thank you, Jack.
I just want to add, I guess, one thing just in terms of the IPO. I think it's important to realize that just the dynamics of how some of these high-flying, sort of high-visible IPOs have worked. So Airbnb, example today, the stock was priced at the initial opening at $68 a share, right? And so when it actually opened, and so there's a set limit at that price that only a certain amount of investors have access to, the majority of the public does not. The actual opening price of Airbnb, I think, was $146 per share. So the general public couldn't even purchase the stock until it opened at that very high price. And so when people look and say, well, an IPO was up, 100%, 200% on the day, the reality is that the majority of the public can't get access because of that initial pricing dynamic of when that happens. So I think that's just one thing to consider when people talk about an IPO and how successful it was on the opening day.
Yeah, good point. There tends to be a lot of excitement and hype sometimes at the beginning, and sometimes it's best to let things play out a little bit before you consider jumping in. Great. So we have gotten a number of questions around the Biden tax plan, and I think there's a number of angles to approach these questions from. And so one is really from a planning standpoint in terms of how it impacts individuals and households. And then the other is from an investment standpoint and how it might impact the market overall or specific companies that we own. So I might start by addressing a little bit on the individual planning side. The election has certainly made planning around taxes extremely challenging. And the reason for that is we're all aware that there will be a runoff in the Senate and that those special elections will not take place until January. And so by that time, we will not be able to do any planning for 2020 with any certainty. And so basically what we look at is kind of a range of outcomes. And so if the Republicans do retain control of the Senate, it's very unlikely that any major tax legislation would be passed in 2021. And perhaps a package might be passed in 2022. Now, if the Democrats gain control of the Senate, of course, with Vice President-elect Kamala Harris being the deciding vote, then I think that opens the door wide open for potential tax changes in 2021. And so with that information, I think individuals are left with what is being proposed and what actions, if any, can be taken in 2020 in the event that that's the outcome. And so I basically selected 3 items from the proposed changes that I thought might be relevant to many of our clients. And one is an increase of the top tax bracket, that's hard to say, top tax bracket for individuals. And if you're in the range of $400,000, $500,000, $600,000 a year, then there may be some planning opportunities to realize more income if possible in 2020, because you likely would be impacted by higher tax rates. And one of the ways that we can do that is through Roth conversions or distributions from your IRAs. Another point that's being considered is a potential raise to capital gains tax rates for those people who have dividends and capital gains that exceed $1 million. And the tax rate would be applied to amounts over $1 million. So again, if that describes your situation, then perhaps pulling capital gains into 2020 might make sense. And then the last piece that's being proposed that I think is relevant is potential changes to the estate tax limits. And so currently they are around $11 million for an individual and $22 million for a couple. And part of the proposal is potentially reducing those tax limits by cutting them basically in half, and potentially eliminating the step up in basis that is granted at someone's death. And so I think you can see that there's a lot of complexity to what's being proposed. And so if any of these things apply to your situation, the best thing is really to reach out to your advisor to have a discussion about your individual situation to see if there's any changes that should be made before the end of the year, or at least considered. Now with that, I would like to hand it over to Matt to talk a little bit about potential changes to the corporate tax rate and how that might impact our companies.
Yeah, thanks, Cynthia. That's a great overview of the changes. I guess from an investment perspective, the primary concern we're focused on is the proposal that would raise the corporate tax rate from 21% to 28%. So we evaluated the impact of what that proposal would mean for our companies, and basically the math worked out such that the fair values we assigned to them probably wouldn't be reduced by much more than a single-digit percentage, all else equal. But then since we focus on high-quality businesses with strong management teams and pricing power, it's possible that any tax losses would be offset with efficiency gains or pricing actions. And then, as Cynthia explained, passing the proposals through Congress is probably going to be a challenge. So even if both Democrat candidates for Senate in Georgia win their runoff elections, the Senate would be split 50-50. Yes, then Vice President Harris would cast the deciding vote in a deadlock, but voting to raise taxes is always unpopular. So it's unclear how much political capital would, politicians are willing to spend on this, or if the proposal would be watered down. And that's why I think the scenario planning that Cynthia talked about is probably pretty important.
Great, thank you, Matt.
You're welcome.
So let's transition now to another question that we received. So this is a broader question, but what type of investment themes are you guys thinking about and interested in for the future? And how might our portfolio benefit from them? So Jack, why don't we go ahead and start with you?
Sure. I'll start while talking about payments, right? So an ongoing and massive secular shift that is happening across the world is the shift from cash to digital payments. Using cash is inferior to digital payments. It's costly, it's not as secure, and not as safe. It's often used for illegal activities, and it's literally very dirty, right? As the pandemic has made abundantly clear. Digital payments are orders of magnitude better in every sense. Governments, consumers, and now even merchants want digital payments. And adoption is happening. It's been happening in a world that sees, tens of trillions of dollars being exchanging hands annually just on personal consumption, so payments. And these trends are only being accelerated by the pandemic as people shop more online and use contactless instead of cash for in-person payments. And we think our portfolio is very well positioned to benefit from this. We have wonderful companies in MasterCard, Visa, and Fiserv that provide and enable secure authorization, transfer, and settlement of digital payments. They literally build the infrastructure or the rails that enable these payments, and they're best in class and have wonderful moats. And we believe we will stand to benefit from this theme for many years ahead.
Great, thank you. Matt, is there anything that you would like to add?
Just unmute myself first. Yeah, sure. I think one trend that we're certainly observing and we're exposed to in the portfolio is the adoption of cloud services. It's really a huge trend that we expect will continue to play out over many years. And what we're seeing is as more and more manual business processes are automated by software and new cloud capabilities to displace old systems, we're seeing companies become more efficient and really embrace completely new ways of working. And we own two of the largest providers of tools that drive that trend. So offering both business productivity software and also the foundational cloud infrastructure on which other providers are building their own solutions. So Microsoft's Azure is the second most popular cloud platform behind Amazon's AWS. It's growing very fast. They also have their 365 suite, which includes not just Excel, which we're all familiar with, and Outlook, but Dynamics, CRM, and the increasingly important Teams, Microsoft Teams collaboration software, which is really quickly becoming the operating system for small and large businesses. And that's really a trend that's accelerated by the necessity of working from home due to the pandemic. Then with Alphabet, you have the Google Cloud Platform and their Workspace Office Productivity Suite, which competes with Microsoft, both of which are growing very fast. And the business has actually now reached sufficient scale that management has decided to start breaking out both revenue and profitability for that segment beginning this quarter. And then I'd also add we're evaluating other businesses that benefit from this trend for the portfolio. And we really like the recurring revenue and high margins associated with software businesses. So we hope to identify additional companies in the space that meet both our quality and value criteria to get them into the portfolio.
Great, thank you.
You're
So go ahead, Michael, please.
Yeah, I'll just add another major investment theme that we're exposed to, and it's the rising penetration of e-commerce. And there are two aspects to it. First, consumers want to shop online. So the strongest retailers with the most defensible business models are adjusting to this new reality by shifting to an omni-channel model, while the weaker players that are unable to adjust are left struggling. The other aspect of it is that digital advertising allows businesses to reach their consumers more effectively, while other tech platforms make it easier to conduct commerce online for anyone. So we see an increase in businesses bypassing the middleman and leveraging the internet to go directly to their customers. So when we look at our portfolio, we see Grainger, Lowe's, CarMax, Ulta, Zebra as prime beneficiaries of the shift to the omni-channel strategy. And we see Visa, MasterCard, Facebook, Google, Zebra as beneficiaries of the shift to direct to consumer.
Great, thank you. So certainly a company that's been in the headlines a lot lately is Facebook. And I'm wondering, Matt, maybe if you could talk a little bit to some of the lawsuits and the potential for breaking up the company and how we think about that.
Sure, absolutely. Also a very timely question, because as most people on this call probably know, 46 states were joined by the FTC in filing a lawsuit yesterday, arguing that Facebook has engaged in illegal anti-competitive behavior by buying competitors and limiting competitor access to Facebook's platform. And that suit, as you said, is asking the court to consider forcing Facebook to unwind the acquisitions of Instagram and WhatsApp, as well as allow greater third-party access to the platforms. So I guess the first thing I'd point out is this suit shouldn't really come as a surprise to anyone. We covered the likelihood of antitrust lawsuits and their impact on both Facebook and Google on our client call more than a year ago, and in a blog post on Summitry, on our Summitry website this February. So we don't think the lawsuit is likely to succeed, actually, for a number of reasons that I'll get into in a minute. But it's important to keep in mind that the legal process will likely take years to play out if there's no settlement. And even if the case is successful, we don't really think the proposed remedies, including breaking up the company, are particularly likely to harm shareholders. So I guess why don't we think the lawsuit is likely to be successful? Well, Facebook acquired Instagram nearly a decade ago, and the deal was unanimously approved by the FTC in a 5-0 vote. And that's even after reviewing internal communications from Facebook that expressed fear Instagram would grow into a successful competitor. And then since the deal, rather than stamp out competition from Instagram, Facebook actually invested heavily to grow Instagram into a massively successful global business. And for what it's worth, that current FTC isn't exactly convinced the case has merit either, since the commissioners only voted 3-2 in favor of joining the suit. And then there's also some inconsistencies within the suit itself. So the lawsuit argues both that social networking is a market distinct from messaging, and that Facebook's acquisition of WhatsApp messaging business was also anti-competitive. So it's kind of contradictory. Then the FTC also fined Facebook $5 billion, as we all remember, for allowing companies to access the platform after those companies abused the access in ways that harmed user privacy. And now the FTC is arguing that Facebook's actions to limit access to their platform is anti-competitive. So it's another contradiction that's going to be hard for them to explain in court. But anyway, let's assume that the lawsuit wins. We really think the proposed remedies are unlikely to negatively impact Facebook. We shared more detail about this in our February blog post, but the key point is that being forced by the government to alter business practices is really unlikely to harm Facebook, because for the most part, their market power comes from not illegally restraining competition, but leveraging the scale they have to provide consumers with superior products and services. And then we further argued on our September 2019 client call that if you broke up Facebook, it could actually lead to a higher market value for shareholders based on our sum of the parts analysis. If you add up the value of Instagram, WhatsApp, the core Facebook business, it's possibly worth significantly more than the current market price. So I think hopefully that's a good summary of why we're not particularly concerned about this particular lawsuit.
Great, thank you.
You bet.
So I think this is a question that's on a lot of people's minds. And how do you reconcile the market hitting new highs while as we are sitting in this pandemic, we're aware that there are a lot of people who are unemployed, a lot of businesses that are suffering, and that consumer spending in a lot of our households has declined significantly. And so how do you think about or explain that disconnect between the market hitting new highs and maybe what we see economically in our everyday lives?
I can start with that, and then maybe if others want to chime in. So I think that's a great observation and a great question, and it is very, very unfortunate. All of the impact we're seeing on small businesses in our communities and around the country and around the world, really. But in terms of the market impact, so the S&P 500 or the market is not the economy. A lot of the smaller businesses that are most impacted are not included in the market. And the S&P 500 being a capitalization weighted index, a lot of the biggest companies have a disproportionate impact on the performance of the market. And those are companies that have benefited from a lot of the reaction to the pandemic, whether it's technology companies that provide the tools that we all need to be able to work from home effectively, or larger competitors that are better capitalized than the small businesses that are struggling or are taking significant market share in this period. And those are the companies that are in the S&P 500, not the companies that are going out of business. And then it also goes back to slides we shared earlier today. The current year's earnings are not a particularly important factor in the valuation of our businesses. So the market is forward looking. You can't invest in the rearview mirror. You got to invest through the windshield. And at some point, as Michael discussed with the vaccines, we're getting close to a resolution on the virus, and we're starting to discount what the future looks like in the markets.
I had a number of points that I wanted to make, but Matt just made them all.
I'll let you answer first next time.
And I would just add that while certainly the market is hitting new highs, I think there's definitely instances of businesses that we think are significantly overvalued, but we also think that there are businesses that are attractively valued and some that are significantly undervalued. And I think that is one of the benefits of looking at sort of individual securities and coming up with an assessment of what that individual business is worth. We can have a much higher degree of confidence on the valuation of the business than we can as compared to the overall market and a basket and collection of stocks. And I think one of the slides that there are a whole bunch of factors influence this, but one of the slides that Kurt showed was sort of relative multiples based on where we are in the inflation rate, what range of band of inflation we are. And if you remember back to that slide, or if we can show it, that 0 to 2% is sort of the sweet spot for higher valuations as reflected by multiples in businesses. And so I think it's the 0 to 2 is the highest multiple. So we've seen a multiple expansion. And you also compare that to sort of the other alternatives out there, whether it's cash or even fixed income. That very low interest rate that we're receiving on cash and fixed income makes the stocks even more attractive. And so I think that is another contributing factor to the things that Matt outlined as well.
I will make one further point, and that is that I think that the Fed should be credited with an assist here. And if you look at the way that they intervened in markets, and the M2 money supply would be a great indicator to look at, is absolutely spiked. On the flip side, the velocity of money, in other words, the way that money has flown through the regular economy is still relatively slow. So where does that money go? And that money has gone into these sort of fungible investment assets, and whether it's bonds or stocks or whatever, the money has flowed there. So it certainly impacted the markets over the last several months.
Great. Thanks, Kurt. So we have received a few stock-specific questions, and maybe I'll start with a stock that's in our portfolio. So Microsoft's stock price has flattened a bit lately, and wondering if you could just comment on that and our outlook on the company.
Sure, I can take that one. I mean, it's been phenomenal for such a long period of time. Maybe it needs a rest. But in all seriousness, I don't know. We don't pay particularly close attention to the stock market, the stock price movements, as much as we're focused on the performance of the business, the earnings, cash flow, growth rates of the fundamentals, and how they're executing on their business strategy. And then relate that to the valuation where it's available in the market, and trying to understand if it's overvalued or undervalued. I think, Microsoft has been such a strong performer. It is no longer as cheap as it was. And that probably makes it a little bit harder for it to generate, or it definitely makes it harder for it to generate the rates of return going forward that we've experienced in the past. So that's possibly part of what we're seeing. But the company is incredibly well positioned for the future. I mentioned their Microsoft Teams product earlier when we discussed themes, and that has become an increasingly important tool for many, many businesses, and is likely to be a sticky, high-value service that is under-monetized, that could lead to significant future growth, in addition to their Azure cloud services, which are growing at a very rapid rate. And we think they're executing very well. The future looks bright, but the rates of return on the stock probably just won't be as high as they have been in the past, because it's been so successful.
Great, thank you. So Jack, you talked a little bit earlier about the theme in the digital payment space, and one of the questions we got was around PayPal. Is that a company that we've looked at, and do you have any perspective on that?
Yeah, I mean, we haven't done work on it recently, but it's a company I follow, and I've done a little bit of work on in the past. So PayPal is interesting. It's a great company. The value proposition for PayPal is they provide security or gateway services for digital payments. So the fastest growing kind of e-commerce space where people are buying things online, PayPal provides a gateway service, and that's their to make it secure and safe. The other thing that's unique about PayPal is they own not only the merchant relationship, but also like you and me and many of us on this call, we probably have a PayPal account. That's a little bit different than Visa and MasterCard, which are still lagging in that department in terms of owning that relationship with the end consumer. So they could do a lot of things with that because of that. For example, they also own Venmo, which allows peer-to-peer and drives a lot of potential, I would say, into other forms of payment using Venmo and PayPal itself to pay directly with merchants. So with that all said, we haven't looked at it recently. To get comfortable with it, we have to understand you know, if shares are pricing in all this potential that they have with their Venmo assets and the ability to kind of monetize that into going into paying with merchants, all the way to their new crypto offering, which is maybe a basis for creating an alternative payments ecosystem, much like a WeChat or an Alipay down the line. But we don't know. We have to do the work to get comfortable with that.
Great, thank you. And then Matt, another company that is part of kind of the themes that we were talking about with cloud computing is, maybe you could comment a little bit about Amazon and potentially why it's not currently in our portfolio, or how we think about it.
Sure. Yeah, Amazon is an incredibly impressive company that's really a cloud pioneer. But obviously it's much more than that, right? There's a massive online marketplace business similar to eBay, but much larger, and a direct retail business, and nascent advertising platform, and video streaming service. So it's a big, complicated production, but very successful. It's one we follow pretty closely. The reason we don't own it is we just haven't been able to get comfortable with the price, and we own so many other businesses that have similarly strong positions and similar exposures, whether it's in e-commerce or cloud, that we feel okay not owning it, and we're just not going to buy it until we are able to get it at a price that we're comfortable with. But we'd like to at the right price for sure.
Great, thank you. So one other question we got that's company specific relates to our sustainable income portfolio, and that's a portfolio we run that focuses on cash flow through companies that pay consistent dividends. And so the question regarding that portfolio is around the energy stocks. So we do own Chevron and Exxon in that portfolio. And Kurt, I'm wondering if you could comment a little bit about those holdings.
Sure. And I imagine there are a lot of people on this call who are not in sustainable income. So I think as Cynthia mentioned, that it's a portfolio that's designed for that client who needs to draw income from the account. It's meant for portfolios in IRAs that are facing RMDs, is for foundations and other accounts that are required to pay out certain amounts of money every year. And the idea is, where do you get the cash flow to pay out to clients those monies? Do you do it out of principal, or can you take it out of income? And in this environment with low interest rates, it's really hard to find income. We feel that there are attractive opportunities in equities when you get the income from dividends. And so that's the purpose of the sustainable income. In that, it's all dividend paying stocks and some preferred stocks and some other fixed income oriented stuff that pay out dividends. But two of the 30 some holdings are Chevron and Exxon. We hold those for specific reasons. I mean, Exxon and Chevron obviously are struggling with oil prices down where they are in the 40s. Their response to that is that they're going to stop investing capital in projects that require oil prices to be at $60 and $70. And because their capital expenditures have dropped, their cash flow is pouring in. The cash flow covers the dividend very comfortably. And so we still hold those securities, notwithstanding the pressures that they feel as businesses, because they can service the dividend payments. The yields are high, and consequently, we think that there's room in the portfolio for them. But as in any portfolio, we look for opportunities to buy and sell securities, and always to upgrade the portfolio. There's no sacred cows in the sustainable income portfolio. Those are in today. They may not be in months from today.
Great, thank you. So I think we have time for one more question. And if we didn't get to your question today, we'll be following up with you individually just to make sure that everyone's questions are answered. And thank you to the audience for your engagement today in terms of the questions you asked our panel. Wonderful questions. So Colin, this question I'm going to direct to you. So sometimes we're selling, most recently we sold Apple in the portfolio. And oftentimes when we make those decisions, the money is shifted into cash or sometimes bonds. And that might give the perception that we are moving away from a certain sector or industry. And in this case, we'd be talking about tech. So maybe you can comment a little bit about the perception of moving out of tech, maybe into things that are more conservative. Yes.
Sure. So I would say we're certainly not moving away from tech. It remains our largest holding. And I think we talked about a lot of the themes that we're seeing unfold that are presenting with that attractive opportunities. So by no means are we moving out of tech. I think in the case of Apple, it came down to, and we talked about this on our last call, about valuation and sort of expectations for the future and how the business was, in our opinion, priced for more than perfection in terms of the opportunity in front of them. And I think some of the names we talked about as well, the expectations are so high that we just have a difficult time justifying the valuation in some of these technology-oriented names. And so our focus is finding great businesses that can grow and trade an attractive valuation, and a lot of those remain in the tech sector. So when we're making a decision in the portfolio to trim a position or sell something, sure, it might be allocated into cash or something else. That's really comes down to what the overall allocation is, and it's more for the instance, if it's moving into cash or fixed income securities, that's really just a rebalancing. And if you think of what Apple has done and a lot of these technology names have done, they're up 70, 80, 90, 100% on a year-to-date basis. And so that sort of their allocation and their weighting in the portfolio is skewing it to become more top-heavy based on from the equity percentage. So we want to take some money off of the table. So we've trimmed some names. We like Microsoft, but we've trimmed Microsoft because it's gotten too big of a percent of the portfolio. And so we're reallocating just to maintain that diversity based on your objectives and your asset allocation. So no, by no means are we moving out of tech. It's one of the most attractive areas for us.
Great, thank you. Well, unfortunately, that's all the time we have for today, but I do want to thank everyone for joining today's webinar and wish everyone a happy holidays on behalf of the Golub Group. And we'll look forward to our next call, which will be in March in 2021. We'll talk to you then. Thanks, everyone.
Thanks, everybody.